Hello, everyone, and welcome back to the channel. This is Fair Value Finder, and today we are taking a look at Tyson Foods, ticker TSN. They just had earnings and have been a little all over the place. They dropped a lot off of their miss on earnings and the fact that they're going to be closing 3 of their chicken factories, and then they continued to rise throughout that day and have continued today even to rise. And now they're back up to $55 when they had dropped all the way down to about $50. We looked at this stock back in May. On May 9th, we looked at the stock. It was just under $50. And I said that I think that there's a lot of support at that $50 level, and it was likely to go back up there. And it was a point where I would be willing to buy in. In fact, I did buy in, and it went on the buy list. So it remains on the buy list. I still think that it's a buy, but I don't know if I want to double down on it. Not with the fact that it's up to 55 now. We've already missed out on 10% since we last took a look. But on May 9th, we looked at it. So I recorded the video, and then I bought $500 worth of stock. And then I did a put credit spread, which I believe I talked about in the video too, where there was so much support and it was at a margin of safety level where I wanted to buy and I wanted to start to trade. So I made $103, and then I put 100 of that straight into shares. And then apparently the next day I continued to buy, and then I continued to buy, and I continued to buy, and then I traded again. So 103, 48, 80, 40, 20, 35. And then it got to the point where my orders weren't filling. And I'm not going to chase it. I'm just going to try another time. So I got one filled here. And right now we're in the high to low 300s in trades. Here's another 10. Looks like I rolled something. 18, 10. And over this time, I kept buying shares too. Looks like I put in another $870 on July 26th, where I likely sold out of another position and thought that Tyson was the best place to put the money. And well, that position's up 1% now. But it would have been nice if I had done that back when we last took a look, and I'd be up 10%. But that's what we're talking about here on this channel, where we are looking for what a decent margin of safety on a stock would be to buy in. Typically, it's something that's going through troubles to be a value stock, but they definitely have a path out. They look fine fundamentally, and we just buy them up anytime that they're underneath that level. And if we can, trade as well. And so that's exactly what we did here. We made $400 to $500 off trades plus 10% on shares over the course of 3 months. Now I'm going to continue to hold this. It's not to overvalued stages yet. I don't know that I'm going to continue to buy in quite as harshly, but it is a stock of interest to me. So we looked back in May at the stock and don't need to concern ourselves too much about the numbers from 2019 and 2022. You can go back and watch the video on that. Although that was one of my earlier videos where I was doing things a bit differently, and we have a bit better of a method here. So some things with the gross net and EBIT are kind of all over the place. But aside from that, the stock looks really good. Revenue is trending up, balance sheet trending up, the liabilities trending down, tangible assets have moved from negative to positive, the tangible book value is positive and growing. Cash flows kind of all over the place, mostly flat around that $2 billion mark. Dividends, they're nice, slow growth, but it's still growth. And then we'll talk about this price page later. But how are they doing for this year? Now they're reporting their third quarter earnings, and we're going to expect numbers to be close to 75% on this. So we see revenue, they're 74% of goal. That's fine. Within 1%, they can have a good quarter, come in and hit it. That's completely okay. And if they do hit this, that's growth over last year. It's not massive growth, but it's definitely growth. They've been growing about 8% year over year. So it's a slowdown, yes, but it's a tough year. And analysts and we are expecting them to grow further because the meat market is constantly expanding. The population is constantly expanding. So this is something that's probably going to continue, at least slow growth into the future. Well, we'd like to see that 8% level, but we'll see what is in store. Cost of revenue, like we said, this is a tough year for them. So their expenses, their cost of revenue are high. They're coming in 5% higher than we'd expect at this point, and that's driving down their margins. Margin of 5.49 to this point in the year. Traditionally, they've been in the teens, low teens, but they have just had it rough. Right now, they've spent more than they've brought in. They're running at a negative net income and have 100.52% expenses as related to revenue. Now, yes, that's rough, but they've shown historically that they're capable, and this is an exceptionally difficult year. I work as a data analyst, and I work in the restaurant field where we deal primarily with chicken. And the chicken market has been absolutely insane. There were points in the year where it dove down to less than $1 a pound, and now it's up over $1.50, 50% up from where it had been, and it's kind of all over the place. And if Tyson is dealing mostly with the earlier part of the chain, then they're the ones who are stuck with the $1 that people are willing to buy the chicken for, and so their margins should improve as those chicken prices go back up. And that's something that I'd look forward to see going into this next year. This year, they're three-quarters of the way through it, so they're probably not going to experience a whole lot. But we'll see how things go. The earnings so far, they've come in with 15 cents in earnings. We're expecting them to come in at $1.48, and that is not unreasonable. They look low right now, but last year they came in at 9.18. In 2021, they came in at 8.57. So they've brought in more than $2 in earnings in a single quarter previously. In fact, over the past 2 years, they've more than averaged that. So they should be fine. Shares, we have some good news here. They are buying back shares. They've moved from 360 to 355. They had been holding steady since 2019 at 363, and then they started buying them back in 2022. So they seem to believe that their share price is low. And when we look at what it's historically been, they were $90 a share back in 2019, and there are less shares on the market. They're coming in with higher revenues. Yes, the earnings this year are down, but if they can get back to those 2019 levels, the balance sheet's in a better place, the cash flows are doing better. It's definitely a more valuable company than it was back then. Now we move on to the common stock equity. That is down quite a bit, almost $1 billion. Not a huge surprise when they're running at negative net income. That is something that we need to keep an eye on. They're running at a negative cash flow, of course. And so those are way off of what we're expecting. And then the assets and liabilities, their assets are down, their liabilities are up. So that's what you would expect to see when they're running at a loss. They're going to have to cash in some of those assets and take out a bit more debt to continue running. But they definitely have some cash on hand to continue operations. $2 per share, almost more than three times what their current loss is at for the year. So they could continue on this track for quite a while longer if they needed to. And that's most of what we're looking at here. So when we look at 2022, we see that their fair value is right around $74, which would have given us a margin of safety, 63. and a reevaluation around 82. And the stock ended the year at 62.25. So right in that margin of safety area. And now 2023, if they're able to come in as expected, looks like some things might shift. The balance sheet valuation might go down. The weighting on that is pretty low, so I don't think that's a huge concern. We'll see where they come in at on earnings. Hopefully, they got a good quarter in them. Maybe even better than $1.48. If they can pull out one of those $2 quarters, this stock will probably jump quick. And cash flows, they got to pull those back positive because that is a pretty big driver. There's not a huge weighting on it, but they do pull a lot of value off of that. And that's what supplies their dividend, which gives quite a bit of value too. Now, I put my personal metrics in here as well, where I say, you know what, for a stock with this kind of balance sheet, dividend, earnings, this is what I would personally be willing to pay for it. And I still have this thing at $90 that I'd be willing to pay. So I'm happy that it's down at 55. And if they come in on track, our margin of safety would be 50. So that's why I'm saying I think that it's going to stay on the buy list. Probably not a double down buy. If we take a little bit more into our scope, we come up with a margin of safety around 57. So it is just below that. We'd be looking at a fair value around 67. And then we'd want to reevaluate around 74. But we can get into the price chart over here and really see a better picture of how things are going. So the dividend, just some nice consistent growth. They've been growing that thing pretty well, a few cents per year, per quarter. And yeah, it looks like that's coming out to 5.74% year over year growth. So that's pretty good. Right now, it's below that level. So unless investors think that the negative cash flows put the dividend at risk, then it would be a decent buy as a dividend stock. Earnings have gone way down. They look like they're going to bounce back this next year. Like I said, the markets are crazy for commodities, which is mostly what they deal in. So we'll likely see a pretty good bounce back this next year for the stock. And we'll see this valuation ideally moving up to the range up in here, which would be 60s to 70s. Cash flows, like we had seen, they're kind of all over the place. They go through periods of 2 years of consistent and then something crazy and then 2 years of consistency. The 2023 and 2024 expectations are lower than 2020 and 2021, but I am just using their cash flow yield for the previous time frame. So the 2022 and 2019 numbers would be dragging that down. And then the balance sheet, we just see that thing going crazy. Now, there might be a bit of a drop in it this year. We'll see how things go. If they do trend up in liabilities and down in assets, that's definitely not something that you'd want to see for that valuation. But it is so high that it's not going to affect the outlook all that much. And that's what we're looking at for the stock. I read over the earnings, and the CEO just said that it's an exceptionally difficult year for them. And clearly, through this, it is. I feel it as well at my company. And they're shutting down 3 of their factories. So that will definitely help them cut costs. Uh, Ideally, they're able to shift the demand to other factories that they have and not need to reopen those 3 and be able to produce as much, if not more, in better facilities. But we'll see what happens. You know, they've had facilities burned down this year, just like most companies have, and it's just been tough. But they've got better management in place, and things are looking bright for the future. And analysts seem to think that they're going to have a nice bounce back this next year, like I do as well. But that's what we have for this stock. So I want to thank you guys for watching. Please like if you enjoyed the video. Comment if there's any other earnings you want us to take a look at. Subscribe so you can stay up to date on everything, and I'll catch you next time.